12:30 p.m. only on Bloomberg Quint.
One of the sectors that's been in focus recently is the real estate sector. We've seen the problems that the NBFC sector has faced because of lending to real estate company. But what exactly is the on-ground situation? We talked to one of the largest real estate companies in the country, DLF. Ashok Tyagi, the CFO of DLF, joins me on the show currently. Thank you, Mr. Tyagi, so much for speaking to Bloomberg Quint. Firstly, we're hearing all these news about, companies defaulting, NBFCs lending to companies, and that's not being paid back. What's the on-ground situation currently? Is the state of real estate that bad that, that problems are arising that is now impacting the NBFC sector?
Okay, so first of all, in all fairness, our exposure to to whatever limited borrowing that we have now is primarily in the quote unquote in the banking or the HDFC sort of space. So we aren't necessarily exposed a lot to the NBFC sector. Similarly, our home loans are by and large catered to by the bigger players, ICICI, HDFC, SBI. Having said that, yes, I think a large part of the mid-range and the smaller developers used to, I guess, lean on the NBFC stroke the HFC sector for their financing, refinancing. And I don't know whether it is the challenges in that sector which have caused the stress on the NBFC, HFC side or vice versa. But clearly, whatever one reads in the papers, etc., I think there is some degree of stress that has seeped in from the HFC stroke NBFC sector onto the smaller medium developers, and maybe vice versa as well. I obviously would not be able to opine on whether there have been actually any defaults or not, etc., because honestly, there's no data on that. One only keeps on hearing speculation, which I don't think I would want to comment on.
Fair enough, Mr. Tyagi. Let's talk about what's happening at DLF. What's the on-ground situation? Is traction happening? Because the reports that we read, indicate that inventory levels, not only for you, across the real estate space, inventory levels are at record highs. The traction in sales is not happening. Is that something that you're sensing that's happening in the markets that you operate?
So let me just take you slightly back, at least as far as we are concerned. About 6 months in 17-18, when the RERA was being rolled out, when GST was being rolled out, we had sort of halted sales completely to fully understand the new regime. We restarted sales somewhere from November 17 onwards. And in all fairness, our sales have been running at a decent clip of between 600 to 650 odd crores a quarter. Sales for the last fiscal were about just north of 2,400 crores, which while obviously is lower than what we used to do at our peak a few years back, was still double than what we did previous year. We anticipate the sales this year to be about 2,750 crores, which again is a slight increase over what we did last year. As far as the inventory is concerned, I think you will have to break the inventory into two segments. One is the ready inventory, which some players, including us, have, and where frankly we are seeing greater traction from the customers. A large chunk of inventory, unfortunately, is in the quote-unquote stressed space, which one keeps on reading, and of cases which are there in NCLT, Honorable Supreme Court, etc. And that inventory is either at an extremely unfinished stage or early stage or launch stage. And frankly, while it can be counted as inventory, I think unless a solution is found, there runs a clear, at least a significant risk in parts of that inventory, whether it will actually ever see completion and fruition, frankly. So I think you have to differentiate between the finished inventory and the quote-unquote WIP or stressed inventory.
Mr. Tyagi, let's speak about DLF in particular. The focus that you said in the fourth quarter conference call, and that was basically in terms of achieving restructuring via deleveraging. What's that situation right now? Where have you reached? What are the timelines in terms of deleveraging? Where do you see yourself over the next few quarters?
So actually, from a balance sheet restructuring standpoint, there were essentially three components. The first one, which happened in December 17, was the infusion of the entire GIC money when they acquired 1/3 of the DLF Cybercity stake. The second was a successful completion of our QIP in March. And the third was the infusion of the residual promoter money into the company, which is happening within the month of June. Actually, a large chunk of it has already happened, and the residual will be completed in June. With these three, our net debt, which was running at about 4,500 odd crores as of March end, and added to it was about 800 odd crores of land liabilities. So that number of 4,500 plus 800, we expect should be down to about between 2,000, 2,500 crores, somewhere in that range by March of 2020. Just to give a perspective, our EBITDA for the year should be north of 2,000 crores. So actually, next year onwards, our ongoing EBITDA to interest ratio will be almost running at 10:1 ratio, compared to what it used to be almost 1:1 a few years back. Even this residual 2,000 crores more debt that we have, we should run even that down to zero across the next few quarters. So really, from our deleveraging balance sheet structuring standpoint, that chapter is almost complete. Our sales engine restarted, and we have a significant finished inventory, because even in the years when the sales were weak, we sort of did not stop completion of our projects. So we completed every customer commitment, every inventory, and we have now close to 11,000 crores of inventory as of March end, which we expect to liquidate in the next 3 to 3.5 years. We have commenced construction of one new project, a residential project in central Delhi, again in partnership with GIC. And we should be commencing construction of two commercial projects in Gurgaon, and this is commercial, not in the Cybercity environment, but in the commercial for sale environment, and possibly one residential project. Going forward, as we have sort of intimated in the past also, we don't propose to sell at an early stage, we propose to sell at a late stage. On the rental side, our rental piece should grow up from about the 2,800 odd crores right now to almost 4,700 crores in the next 3 years, fueled essentially by the contractual escalations and mark-to-markets, by the transfer of certain assets from DLF to Cybercity, and by the build-out of 3 new assets that we'll commence construction on in this fiscal: one in Delhi, one in Chennai, one in Hyderabad. One in Gurgaon, one in Chennai, one in Hyderabad. Sir, so that's the broad lay of the land as far as we are concerned.
Okay, sir. DCCDL has close to 29 million square feet of operational space. Give us, more details of what is expected in terms of new avenues that will be added here. What's the run rate going to be here as far as this business is concerned?
Okay, so DCCDL, you're right, has about 29 million square feet. It should be, that 29 million square feet by the end of fiscal 1920 should be about 35 million square feet, because there's about 3.5 million square feet is being completed this year, 2.5 in Gurgaon, about 1 million in Chennai, which will be transferred to, which they will have, and about 3 odd million square feet should be transferred from DLF to Cybercity, one of which, the 2 million square feet Mall of India Noida, has already been transferred. The total development potential in Cybercity beyond this is almost touching 30 million square feet, which we hope to develop and complete in the next 10 years. And that is the reason we expect DCCDL to keep on growing at a clip somewhere in the late teens, and maybe touching a CAGR of 20 also, but at least definitely a 17-18% CAGR is something that we clearly look at from a DCCDL portfolio on an ongoing basis.
How do you see profitability shaping up in the development company, and what's your sense of what will happen on the residential side of the business?
Okay, so as I said, we had an inventory of about 11,000 odd crores at March end. We expect that to get liquidated in a period between 3 to 4 years, depending on how the market is. In a very optimistic scenario, 3 years, maybe slightly cautious scenarios, 4 years, but somewhere in that range. Because I mean the total profit on sales made till date and the unsold inventory is again about 11,000 crores. About 5,500 crores is the unrecognized profit on the sales done till date, and about 5,500 crores is the total EBITDA on the inventory. So again, we expect that in the next 4 years that most of that EBITDA should get recognized. We'll obviously get the 2/3 of our share of the Cybercity profit over and above that, and against that we basically have our annual overheads and taxation outflows and a very small interest outflow for the next year or so. So obviously we don't give profit guidance per se, but we expect that the entire profitability of the development arm and coupled with the 2/3 share of the rental arm should keep on growing at a reasonably strong clip across the next 4 to 5 years.
Our conversations with some of the analysts and some of the property consultants do believe that South India is somewhere, especially Bangalore, is where traction is the maximum, where inventory levels are getting taken up significantly much faster than the rest of India. Is that an avenue that you're looking at apart from NCR, where you're strong? Where is South India or any other geography where you are looking to build projects or take a bigger stake?
So in the commercial rental, the leasing market, we have a big presence in Chennai. We are about to embark on another 7 million odd square feet development of a rental property in Chennai, and we have assets beyond that as well. Similarly, in Hyderabad, we should be commencing construction of a 3.5 million square feet rental park in Hyderabad. Then obviously we have the entire NCR. On the residential side, while we have unsold inventory in Indore, Lucknow, Chennai, Chandigarh, which obviously we are committed to selling and completing and giving the guaranteed quality of lifestyle to our customers, we are currently not envisaging launching any new projects in those areas. So at least for the next couple of years, we continue to focus primarily on NCR, Delhi and Gurgaon to launch new projects. Obviously, one can never say about the future, but right now the broad vision is let's focus new projects on the residential side in NCR, while we obviously develop the commercial projects across the country. We do not have a presence in Bengaluru right now, and maybe sometime in the future we might have a commercial presence. Right now we don't. On the residential side, we did complete very successfully 2 residential projects in Bangalore in the last few years.
Okay, Mr. Tyagi, we leave it at that. Many thanks for speaking to Bloomberg Quint. It's always a pleasure to speak to you.